Who is BBY? Once a category killer in home and bath items, the big bucks company has gone downhill and continues to decline. Bed Bath & Beyond, founded in New Jersey in 1971, created the big box culture for years. It was a college student ritual, a weekend hangout for home improvement junkies, and a feature of suburban retail complexes. In the US, you've probably received their 20% off coupons. These were ubiquitous, celebrities praised them on TV, and numerous movies featured them. BBBY gives coupons persistently and generously. They're also notorious for the disorderly mess of products on their shelves and racks, which proved tough to reach as they piled on. But this method has been successful for years. Its annual income rose from $9.2 billion in 2009 to $12 billion in 2018, and its market value peaked at $17 billion in 2013. Where are they currently? However, despite investors' and management's efforts, sales and profitability have declined since 2019. They continued trying but failed. First quarter sales plunged 25%, and the company lost $358 million, leading to CEO Mark Triden's resignation last June. Second quarter net revenues were $1.45 billion, also down 26% from last year. And May, it had $108 million in cash and equivalents and was seeking private financing. Bed Bath & Beyond's revenue is expected to decline 17% to $6.5 billion, and its net loss will grow from $560 million to $665 million, according to analysts. Given these data and projections, Bed Bath & Beyond's stock won't rebound in the next several quarters. This begs the question, why did this category killer fall? Problem number 1. BBBY is about to go down. Number 1. Losing to its competitors, digitization. Bed Bath & Beyond battled Amazon, Walmart, and Target before the epidemic. Sales were lagging due to several big blunders we'll discuss later. Neil Saunders, a managing director at Global Data, said Bed Bath has competition in nearly every aspect of their business line. He asked why consumers would go to Bed Bath & Beyond when they can get identical things from Amazon, for example. They also lacked a digital plan to compete with Amazon and had problems supplying popular products. Number 2. Pandemic. Supply chain disruption. Former CEO Mark Triden's initiatives to add more private label brands complicated the supply chain, making it tougher to purchase consumer products. Even if the corporation bought from trusted producers, his prices weren't competitive. Their high cost was partly due to their decision to employ intermediaries instead of purchasing directly from Vietnam and China as their rivals did. This was easy, but intermediaries needed to raise the price to protect their earnings, thus raising their own prices as well. COVID-19 couldn't have arrived at a worse time. The epidemic slowed down the distribution and further raised pricing. This led to understocking and lost revenue. Due to increasing inflation, customers were hesitant to buy more. They had declining revenues and excess inventory. Number 3. Wrong move by former CEO Mark Triden. Modernization and private labels. Mark Triden was recruited as the new CEO in 2019. He pledged $300 million to update Bed Bath's website, product range, and stores. He also intended to lower inventories by 40%, replace floor-to-ceiling storage with practical shelving, and to establish private label brands like Squared Away and Our Table. Customers like private label items at Target, so he believed this was the next move for Bed Bath, offering up expansion prospects. But this failed, leading to a 40% drop in sales after 2 years. Everything he did for the firm was good in theory, but was poorly executed. And then a new player arrived. Before we talk about this new player, if you find value with this video, do subscribe to our channel to get the latest news in the stock market. Twist. Ryan Cohen enters the scene. In the first quarter of this year, GameStop chairman Ryan Cohen purchased a 9.8% interest in Bed Bath & Beyond after criticizing the retailer's management for being very ambitious and suggesting a more acceptable corporate development strategy, such as a new NFT platform. Stock prices rose when he arrived, but also fell as the corporation continued to lose cash. Mid-August, the stock price tripled and Cohen sold all of his shares, making $68 million. BBBY stocks fell over 70% because of this. BBBY was classified as a meme stock, a phrase for equities trading on social media hype rather than economic reality. This social media buzz may be traced to an August 16 article on Wall Street Bets, where the author analyzed Cohen's regulatory filing, claiming he will sell his entire share in the firm. Speculatively, some have requested the SEC to investigate Cohen for market manipulation when the stock plummeted. With all that's transpired, what's left for Bed Bath & Beyond to rise? Number 1. Shrink the business. Shrinking will help the firm avoid insolvency. The company said on August 31 that it will lay off 20% of its 32,000 corporate and supply chain employees, shut 150 stores, and eliminate several private label brands. They are cleaning house. They will also cut selling, general and administrative costs by $250 million and capital investment by $200 million from $400 million. As a result, retail sales would drop by at least 20% as its downside. Number 2. Clean out inventories. Due to the supply chain interruption, Bed Bath lost hundreds of millions of dollars in sales and concluded May 2022 with $100 million in unsold inventory. Their inventory is a mess. They need to update their supply chain. As their rival does, they may have to discount aggressively to clear off their overstocked inventory. This is the greatest moment to offer out their famous 20% off coupons to attract more customers and get rid of extra merchandise, especially since inflation is rising. Number 3. They need to stand out, maximize on what their strengths are. Former Sears leader and analyst Steve Dennis thinks Bed Bath needs a smarter strategy. They may draw inspiration from when Best Buy established Geek Squad when CD and DVD sales dropped and PetSmart added vet care to compete on more than pet food cost. Aside from their new loyalty program, which has 2 million registrations, they need to boost the ante if they want to ascend again. They also need to maximize their significant strengths, keeping their private labels intact such as Simply Essential, which is their own line of bedding and bath items, as well as their baby items frontrunner, BBBY Baby. There were reports that they planned to sell BBBY Baby, but they risk a lot by doing so because its market is solid even in tough times. Number 4. Strengthen the foundations, cash infusion, and sticking close to their core. Bed Bath & Beyond was downsized and received $500 million in new finance, including $375 million from 6th Street. This year, it plans to save $250 million and cut capital spending by $200 million. Bed Bath can use these funds to improve its company till the end of the year and increase its profits. But they're also looking to do more. Sue Gove, interim CEO, told analysts the company is concentrating on satisfying customers, driving growth and profitability, and delivering business returns. One way is through an ad campaign that uses famous brands to tell a new story. Stores will stock lesser-known direct-to-consumer products to reclaim the chain's golden days. Bed Bath & Beyond's new brand president, Mara Serhal, said discovering creative and surprising brands, products, and categories will be a fundamental experience for our consumers. This back-to-basics strategy has helped companies regain their footing back to their path to success. When things appeared on track, another incident occurred. Problem number 2. CFO Arnold Gustavo dies of suicide. Bed Bath's CFO jumped off a Manhattan building on September 4. Arnold Gustavo, 52, was found unconscious outside his 57-story Tribeca Tower, the NYPD stated. It was a shattering loss for the retailer since he assisted them through the pandemic. After working at Avon and P&G, Arnold joined Bed Bath & Beyond in 2020. This tragedy further brought down BBBY's price by nearly 20%. Apparently, Arnold, Ryan Cohen, and other wealthy shareholders were accused of participating in a pump-and-dump strategy to boost the stock price. This creates a whole other story for itself. Bed Bath & Beyond now is currently below $700 in its market cap. As they implement their business plan for the next few months, let's hope to see them finish this year on the right trajectory. Do you think that Bed Bath & Beyond can turn their fortunes around? What do you think about BBBY being made into a meme stock last August? Is it the same with what happened to Cineworld? If you don't know about it yet, click the link in the description box. You need to watch it as well. Comment your thoughts down below, and if you enjoyed today's video, please leave a like. Stay updated with the latest news by hitting that subscribe button. Once again, this is Market Thrive, signing off.